Hi, my name is Nasir Sheikh and I'm a chartered certified accountant in a firm called Hoffman & Cohen, which is based in Knightsbridge, London. Our today's topic of discussion is taking advantage of the wheel of incorporation. Now you may remember that our last video, the topic of our last video was the different business structures available. So some of our viewers asked me to prepare a video that explain on how a limited company would limit their personal liabilities. So I thought I'm just going to make this quick video. So to explain this further, sole traders have unlimited liability for any debts that their business incurs. By contrast, a limited company has shareholders. You can also call them owners of a limited company, who are only liable for company debts up to the amount of any share capital that they own, which will be explained at a later stage. Limited liability is one of the main advantages of choosing to run your business as a limited company rather than as a sole trader or partnership. Now remember, limited companies have numerous tax planning opportunities available too, which will not be discussed on this video but would be in some upcoming videos. So a limited company is a separate legal entity from its shareholders and directors. This is known as a wheel of incorporation. Shareholders and directors' personal assets are not available to meet the debts of the company. However, the money and assets of the company belong to the company rather than to the shareholders personally. By contrast, where an individual operates a business as a sole trader, there's no legal distinction between his or her business and private affairs. This means that the individual is personally liable for any business debts. Now, as explained earlier, that I am going to explain the share capital or the limited liability using an example. So here it goes. So say John has set up a business as a limited company. John owns 100 shares, £100 worth of shares that are fully paid up. He is the only shareholder of the company. Now the business collapsed with debts of, let's say, £100,000. John is not personally liable for those debts. His liability is only limited to his shareholdings of £100. Now, can you believe that? I mean, in comparison, a sole trader would potentially be liable for the £100,000 worth of debts, which is enormous in comparison to a limited company where the shareholder, which is John, will only be liable for £100 worth of debt. So now there are lots of caveats. Now the government obviously is trying to bring in new rules where certain actions of directors may restrict the wheel of incorporation or may lift the wheel of incorporation, but that again would be on a case-by-case basis. It's not common, very difficult for the creditors to do that, but that is something that could be discussed when the questions are raised. But I believe that I've answered or explained the advantages of wheel of incorporation on this video. But if you have any questions, feel free to ask them. So till next time, have a good day.